Hey everyone, welcome back to Corporate Decoder. Today, BNL just filed their second quarter report, and I am seeing some interesting trends in their real estate investments. Quick note, this is not financial advice, just my take on public filings for educational purposes. Their net income has more than doubled. But a closer look at their debt and development projects reveals a complex picture. Let's dive into what Broadstone Net Lease Incorporated is telling us about their business right now. This is primarily a look at their financial report for the second quarter of 2026. Looking at their financials for the first 6 months of this year compared to the same period last year, their total lease revenues went up by about 10%, reaching over $243 million. This growth is mostly due to them buying more properties and some of their development projects starting to bring in rent. But it is not all smooth sailing. Their operating expenses went up too, mainly because of higher depreciation and amortization costs. This past year, depreciation and amortization were over $90 million, up from about $82 million last year. They also had a significant increase in general and administrative expenses, which went up by about $3 million. Largely due to some transaction costs and stock-based compensation. One big story in their expenses is the change in property impairment charges. Last year, they had almost $28 million in impairment charges related to properties they decided to sell. This year, that number dropped dramatically to just $3.5 million. This reduction is a major reason why their net income looks so much better, more than doubling from $37 million to over $86 million for the first half of the year. When we look at just the second quarter, their lease revenues net increased by about 1%, bringing in just over $122 million. This smaller increase compared to the 6-month period is partly because they had fewer property sales this quarter than in the previous one. In that same second quarter, their operating expenses saw a big jump, going up by over 21%. A large part of this was a $7.5 million increase in depreciation and amortization, and a $3.5 million impairment charge. They also reported a $1.5 million increase in general and administrative costs. So, while the half-year numbers show strong growth, the second quarter itself saw a dip in net income compared to the first quarter of 2026, going from over $46 million down to about $40 million. This was mainly due to those higher operating expenses. Now, let's talk about their development pipeline. They have a lot of build-to-suit projects underway, mainly in retail and industrial sectors. For instance, they have a Tesla project in Las Vegas that is expected to cost almost $40 million and should be stabilized by November 2027. They also have a large Southwire project in Georgia costing over $115 million. With a target stabilization date in late 2026, these projects are crucial for their future growth, but they also represent significant upfront investment. Looking at their entire portfolio as of the 30th of June 2026, it is heavily weighted towards industrial properties, making up over 63% of their annual base rent. Retail properties account for about 29%. This focus on industrial real estate is common for REITs today, especially given the strong demand in that sector. When it comes to tenants, they are quite diversified. Their top tenant, Roscoe Baking Company, only makes up 3.8% of their annual base rent, and their top 20 tenants account for about 34%. This diversification is a good sign, as it means the company isn't overly reliant on any single tenant. Geographically, Texas leads the pack with 10% of their annual base rent coming from properties in that state, followed by Michigan and Florida. This widespread across states and provinces in the US and Canada helps mitigate risks associated with any single local market downturn. Let's touch on their debt situation. As of the 30th of June 2026, they had about $447 million drawn on their unsecured revolving credit facility. This facility has a maturity date in March 2029 and offers extension options. They also have significant amounts drawn on unsecured term loans and senior unsecured notes, totaling over $2.6 billion in unsecured debt. This brings us to their leverage. Their pro forma net debt to annualized adjusted EBITDA ratio was 5.9 times. This ratio measures how many years it would take for the company to pay off its debt with its earnings. While it has slightly increased from the previous quarter, it is still within a manageable range and reflects their strategy of using debt to fuel growth. For comparison, when Bed Bath & Beyond was facing severe financial troubles, their debt metrics were far more concerning, signaling a much higher risk of default. The company reported a net income attributable to Broadstone Net Lease Incorporated of $39.8 million for the second quarter of 2026, and over $86 million for the first 6 months. This is a significant jump from last year, where they reported about $20 million for the second quarter and $37 million for the first 6 months. Looking at their balance sheet, total equity stood at about $3 billion at the end of June 2026. This represents the owner's stake in the company after liabilities are accounted for, and it has remained relatively stable. They have significant commitments to fund investments with almost $117 million planned for the rest of 2026. This shows their continued strategy of acquiring and developing properties. It is worth noting their active role in managing interest rate risks through derivative instruments, specifically interest rate swaps. They have 22 of these swaps to lock in fixed rates on a substantial portion of their variable rate debt. This is a smart move in a fluctuating interest rate environment. Similar to how many companies like Home Depot use hedging to manage their financial risks. Overall, Broadstone Net Lease Incorporated appears to be growing its portfolio and revenue effectively, with a strong focus on industrial properties and a diversified tenant base. The increase in net income is impressive, largely driven by a decrease in property impairments. However, the rising operating expenses and significant development pipeline require careful monitoring. The company's leverage is moderate, and their hedging strategies indicate financial prudence. What I'm actually looking for is how well they can execute on their development projects and manage their increased debt levels in the coming quarters. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.